For the introduction, the exchange rate plays a critical role in a country's economy, including to the Malaysia. Its effect to the relative value of one currency compared to the another and can be fluctuate based on economy, political, and global market factor. In Malaysia, the exchange rate of the ringgit Malaysia that's against major currencies such as the US dollar, euro, and Japanese yen. So the significantly impact to the country's export and import activities. So for the export sector, the favorable exchange rate can be enhanced the competitiveness of Malaysia products in international markets, while a weaker exchange rate the increased import cost. Therefore, understanding how exchange rate fluctuation affect the prices of goods, foreign demands, and operational costs is critical for Malaysia's business. And the government in formulating economy politics, these effects are also extend to the impact on inflation, employment, and the country's trade balance. This article aims to examine the impact of changes rate to the Malaysia export and import sector, focusing on current trends and the challenges the nation economy faces in dealing with exchange rate volatility.
Hello, I would like to talk about competitiveness and probability, and second one is increase transaction cost and financial risk. The first one, competitiveness and probability. Exchange rate volatility can alter the price of Malaysian export in foreign market, impacting their competitiveness. For instance, a sudden depreciation of the ringgit can make Malaysian goods cheaper and potentially more attractive to foreign buyers. However, such volatility can also lead the situation where exporters face higher costs or reduce profit margin if the exchange rate move unfavorable. Secondly, increased transaction cost and financial risk. Volatility introduce additional risk for Malaysian exporters, especially those with unhedged foreign currency exposure. Sharp frequency in the exchange rate can affect both the value of export revenue and the cost of imported input, which can crucial for production. This results in increased transaction costs and can reduce the financial stability and exporting business.
This makes exports more competitive in the global market. When a country currency weakens relative to others, its goods and services become cheaper for foreign buyers. For example, if the Malaysian ringgit depreciates against the US dollar, Malaysian products will be cheaper for US consumers, potentially increasing export volumes. This reduces the competitiveness of exports. When a country's currency strengthens, its goods and services become more expensive for foreign buyers. For example, if the Malaysian ringgit appreciates, Malaysian export may become pricier for international buyers, leading to reduced demand.
Cheaper import price. When the domestic currency strengthens, it takes less of the domestic currency to buy foreign goods. This means product and raw material from abroad become cheaper. For example, if the Malaysian ringgit strengthen against the US dollar, product like electronic, oil or import food will become cheaper in the domestic market. Second, lower business costs. When the local currency gets stronger, business that import material or finished good can lower their costs. This means industry that rely on foreign supplies like manufacturing can spend less on production. For example, a company that buy part or material from other country can pay less and they might even lower price for customer.
Currency exchange rates that lead to effect on imports is higher import costs. It is because of weaker ringgit. When the ringgit loses value, Malaysia has to spend more ringgit to buy imported fresh food items such as beef or selected vegetables from other countries. These items become more expensive for businesses and consumers. Businesses will raise prices of the things that they sell for consumers because businesses need to pay more for the same products when the currency is weak. As food is an essential part of people's daily expenses, they still need to buy it. This will make people need to spend more money just to buy the same amount of food. The rising of prices of imported food items lead to a higher cost of living, especially for lower income groups. These things makes life harder for lower income groups to buy basic items like food. Currency exchange rates that lead to effect on imports is making domestic market more open and attractive to global investors. The flexible exchange rate has contributed to make domestic market more open and attractive to global investors. Flexible exchange rate means the value of the Malaysian ringgit changes based on the supply and demand in the global market rather than being fixed or controlled by the government. With greater financials, this will make Malaysia's financial markets more attractive to international investors because of capital flows. They are always looking for opportunities where they can make a profit by easily moving their money in and out from currency movements. A more attractive domestic market can increase global investors in Malaysia. This can strengthen the ringgit because global investors will exchange their own currency to the Malaysian ringgit. A stronger ringgit can reduce import costs. For example, the costs for importing an item such as fuel will become more cheaper. This is because of the local currency is stronger and makes the import items less expensive to buy.
In conclusion, change in currency exchange rates have significant impacts on Malaysia's economy. A depreciation of the Malaysian ringgit make Malaysian export more competitive as their prices become more relatively lower in international markets. This situation can increase demand for key export products such as palm oil, electronics and agricultural products, leading to an improvement trade balance and economic growth. However, a weaker Malaysian ringgit rise the cost of imports, especially for raw materials and essential goods. This results in higher production costs for businesses, which may increase consumer prices and contribute to inflation. Conversely, an depreciation of the Malaysian ringgit may imports cheaper, benefiting industry that rely on foreign materials and helping to control inflation. However, a stronger currency reduces the competitiveness of Malaysian export as their prices become higher in the global market. This could lower demand for Malaysia's product, creating trade imbalance and slowing economic growth. To address these challenges, Malaysia must implement strategies to minimize the negative effect of currency fluctuation, diversifying export markets, investing in advanced production technologies, and adopting effective currency risk management practicing as essential measure. Management practicing are essential measures. Additionally, flexible trade policy and government support for key sectors will help businesses withstand exchange rate changes.